Hey guys, how's it going? Hope everything is going well. Last week I did a video, or it must have been 2 weeks ago. I did a video about rate hikes ahead, goal to spike higher. And in that video, I was talking about my thesis about rate hikes and inflation and the price of gold. And what I was saying was that if you have these rate hikes to occur in March, in my opinion, this would lead to higher gold prices, higher inflation, etc., as long as they continue this path. And if you look at the price of gold right before the Fed announcement, it was around 1198. Shortly after, they raised the rates. Where's gold now? 1230 bucks. I still feel that gold prices will continue to go higher. And I see some people were making comments in the last video. I welcome comments from all perspectives. I get people listening to me who are libertarian, who are moderate, who are MMT guys. I want all of you guys to listen. You know why? Because I want feedback from all of you. And this is how you become a better trader investor, to listen to different parts or different perspectives. And some people were saying that, hey, this is bad science, rate hikes doesn't necessarily equate to rising inflation, this and that. And I was thinking about this, and I don't know if I've explained this clearly. And in my mind, what was going on thinking about this, as long as the interest rates are below the market rate and you're raising rates, this would be bullish for inflation, gold, etc. Now, people are saying, hey, in the 1980s, Paul Volcker raised rates. Yes, he did raise rates, but those rates were above the market rate, like in 1980, 1981. And so, not surprisingly, and the price of gold stopped rising right after that time. And then they had lower rates, and then what happened? The price of gold in the 80s went down. So, that's what I'm talking about. You need to look at, okay, if they're raising rates and it's below the market rate, that would be bullish for gold, silver, inflation. And that's what we're seeing right now. If you look at ever since December 2015. Now, assume what I'm saying is incorrect. What if it is bad science, like some of the people are talking about? Okay, there's other things to look at, and I don't specifically look at raising rates as a signal to specifically buy gold and silver. If some of you have looked at my older videos, I've always talked about the dollar yen. And the thing is, some people may want to look at technical analysis. Well, I think an important part is looking at the smart money versus the dumb money. And I've talked about it. It doesn't work all the time, but more times than not, the commercial money, if you look at the commitment as traders, this is as of Tuesday of last week. The only problem is there's a time lag in producing this data. So it's 3 days behind. You usually see it on Friday. If you look at the long for Japanese yen, it's 148,000, while the short positions were 48,390. This was before the Fed funds rate was hiked. This was as of Tuesday, the data, and then Fed funds rate hike was on Wednesday. That was all baked into the cake, in my opinion, but you usually see a reaction right after Janet Yellen announces, hey, I'm going to raise the Fed funds rate. So when what I said was there's always a correlation for the last, what, 6 years, 7 years in the Japanese yen and the price of gold. If you see this long position in the Japanese yen, the signal is its price of gold is most likely going to go higher. And the non-commercial money, usually the speculators, the hedge fund guys, the mom and pop guys, right? They have a huge net short position in the Japanese yen. And once you start to see the commercial, non-commercial money go long, and you see the commercial money go short, I think that would be a signal. Don't add to your gold and silver position. And usually, when you see the reversal like this, you tend to see the momentum traders, they take control. And I would want to stay out of this. I've seen this a lot of times where you see the momentum guys, the non commercial money guys, they're long like the Japanese yen. While these guys, the commercial money, they're net short. You want to bet on the side of the commercial money, but the commercial money is usually early because they are the hedgers, right? They are in the business of dealing with Japanese yen. So it could be a company like Toyota, for instance. They may be part of the commercial money. I don't know the specific players in the futures market, but if you're dealing with the Japanese yen, or you're dealing in trading, or if you're dealing in selling products in Japan, you're probably a commercial hedger. And they get better interest rate coverage in terms of loans and all that. So they may be in this for the long term. The non commercial money guys, they're trend traders. And I don't like trend trading. I know a lot of people who do this for a living are trend traders, which is fine. Everyone has their own way of investing and trading. I do this for a side gig, right? I don't do this as my full time job. If I did this for a full time job, my perspective would be totally different. I think that's another thing to look at compared to someone who's in a daily basis looking at an hourly chart. I can't do that because I'd be fired from my job if I did that. Now, I wanted to look at also the other way of looking at the Japanese yen, the commitment of traders. You want to look at dealer intermediary short, asset manager, leverage funds short. I want to look at specifically the asset manager. Asset manager guys, they tend to be wrong more than right. They're also chasing per se, and they have a short position in it. Now, once they start to go long, that may be an indicator, or they start to get rid of their short position. That may be an indication that, hey, you know what? Let's not go buy gold. Let's not buy go silver. And speaking of the commitment of traders, last year, gold reached to like 1370. You saw a huge spike in open interest, right? And then in addition to that, you saw a huge net short position in the commercial money for the Japanese yen, and then a huge long position for the non-commercial money in the Japanese yen. So it's things like that. What I'm trying to say is, when you're looking at markets, gold, silver, the stock market in general, you can't use one indicator. I used to do that, and you're going to get burned. You need to look at a variety of things, because for the people that were constructively criticizing me, they're saying it's bad science. And that's why you need to use other indicators as well. And if I'm wrong, I'm wrong, but I have other data to back up why I want to be long, for instance, gold, or why I may not to I may not even want to buy gold at that time. And the other thing is, if you look at it from a fundamental perspective, the debt ceiling debacle is coming up within the next, what, few weeks. I mean, Treasury has to come up with creative ways of trying to fund the government, and that means that there may be cuts. And when you see cuts like that, and you see the whole stock market that has been going up the last 6, 7 years based on government spending, and that government spending is temporarily cut, and there's all this optimism about Trump that made the market go up, what, a few hundred S&P handles. Well, that may temporarily stop. And when that temporarily stops, you see risk off, gold goes higher, stock market corrects, whatever. Now, I feel that they will come up with a solution to the debt ceiling situation, but it's not going to happen overnight, in my opinion, because of the divides of the two party. So, leave your thoughts below. Let me know what you guys think. I do welcome constructive criticism. This is what makes me a better investor or trader in the long run. And yeah, just be civil, guys. All right, I want guys from different perspectives to watch my videos and leave thoughts. All right, guys.